Hello guys. Well, my name is Shankar and I'm a CFA charter holder and I'm an MBA in finance from Carter Business School. Well, I work in eValueServe as a senior research associate. I basically work as an equity research analyst for a bulge bracket German investment bank. So that was regarding me. First of all, welcome you all, and I would like to congratulate all you guys for choosing CFA designation to enhance your professional career. And also I would like to thank all you guys for choosing India Can to achieve your goal of achieving a CFA designation. So welcome you all once again. Today, as you all know, I would be starting with the book 3, the topic Financial Statement Analysis of CFA Level 1. Well, first of all, I would just like to tell you that financial statement analysis is one of the most important and scoring subjects of CFA Level 1. We say one of the most scoring and important subjects for two reasons. Guys, first of all, as you all must be aware by now, financial statement analysis hold a 60% of the overall weightage of CFA Level 1. Like the evening session and the afternoon session combined is the weightage is, the morning session and the afternoon session, the combined, the weightage would be 60%. We have in total around 10 subjects for CFA Level 1, and financial statement analysis itself holds around 60% of the weightage. So it's a very important subject, as you all are aware. So today we are starting with the study session 8, which is earning per share, regarding earning per share. Again, it's a very important and scoring topic because it's a practical topic, right? So you can always, I'm sure you must be aware of the term earning per share. You can very well relate to it with your prior professional experiences, and you have read it in your 12th and 11th classes and in your graduations and in your MBAs. So it's a very easy topic to understand, and I have not, came through any CFA exam which does not touch on earning per share in some or the other manner. So it's a topic which is most likely to be included in your CFA Level 1 exam for sure. So please pay kind attention to the topic. Thanks a lot. So we start with earning per share. What we are going to read in earning per share is basically the basic and diluted earning per share. There are two types of earning per share, and the treasury stock method. That's we're going to cover in the session today. So starting with earning per share. Now basically, what is earning per share? Earning per share is one of the most important performance measures of a company used. It's a most, you all must have heard about earning per share, right? If I'm wrong, please correct me if anybody has not heard about it. Yes, you all have heard. Thanks. So, what is earning per share basically? Earning per share is that how much a company is paying earnings for each share of the company, right? So basically, what is earning per share? We all know that we have preference shares, debts, and equity in the company. Who are the basic owners of the company? Please tell me. Yes, you're correct. It is the equity shareholders who are the basic share owners of a company, right? We have debt. For debt, we have a fixed payment interest, and we have preference shares. For that, we have a fixed amount of dividend which a company needs to pay, which is preference shares dividend. That's fixed. So whatever will be the residual profit is the profit available to the equity shareholders, which is distributed to the equity shares. We all have read that, we all know that, right? So what is earning per share is basically what is the earnings for one equity share. How much a company is able to earn and pay each equity shareholder is called the earning per share. And we measure the performance of the company, how good is the company, how much the company is paying to each shareholders, and this is one of the performance measures, and we evaluate the company, whether it is doing good or bad. So we evaluate the performance of the company. It is one of the evaluation matrices of the company, a very widely and popularly used evaluation matrix. So We all know the income statement of a company. It is something like we have, we have sales, then we say less cost of goods sold, we get gross profit, then we reduce the operating expenses, we get profit before tax and interest, then we reduce the interest. Interest is the payment to the debt holders of the company, right? You all know that. So interest is the payment to the debt holders of the company. So we get the profit and then we reduce the tax and we get the net profit. So this will be the net profit. I hope it is visible to everyone. The net profit. So after net profit, this net profit belongs to, we have already paid the debt holders in form of interest. Now this net profit belongs to whom? The shareholders, which are the preference shareholders and the equity shareholders, right? So there are two type of shareholders. Now preference shareholders have, as I said, has a fixed amount of payment, generally like 10% of dividend, that is fixed. So we pay off the preference dividend and then we have the profit available for equity shareholders. So after reducing the preference dividend from net profit, we get the profit available for equity shareholders, right? You got this point, right? Can I just rub it off? So what is earning per share? We calculate earning per share only for equity shares, right? So what is earning per share will be the profit available for equity shareholders divided by the total number of equity shares. So the number of equity shares. We can also say it is equal to net profit minus preference dividend. You just saw that net profit we calculate after paying off the debt holders and we get net profit and then we pay preference dividend. So this is equivalent to the profit available to, this gives us the profit available to equity shareholders. You got my point? So and now, and the denominator is the number of equity shares. So this is what, how much profit is available, how much profit a company is paying to each equity shareholder of the company, right? So that is called earning per share. Correct. Now earning per share is of two types: basic earning per share and diluted earning per share. So we have basic, we calculate, every company generally calculate two type of earning per share in their reports: basic earning per share and diluted earning per share. So it's fine. So these are the two type of earning shares, and today we're gonna discuss what are these two type of earning share, what are their meanings and how they are calculated, right? To understand that, we first have to understand the need for two earning per share. We first have to understand the capital structure of any company, right? So I move on to the capital structure. Now we all know that we have debt in a company. Every company